Everyone and welcome to today's video. In today's video we will be discussing about cutoff procedures. Cutoff procedures are very frequently asked in interview, and recently a candidate was asked that how to record revenue using cutoff procedures. So what are cutoff procedures? Cutoff procedures are audit procedures which are designed to ensure that assets, liabilities, income, expenses are recorded in the proper accounting period, the period to which it relates to. Now let us understand the cutoff procedures for revenue to understand cutoff procedures better. But before we begin, please understand that in the ERP software, when an invoice is generated, the accounting entry gets posted automatically at the bank end. So the entry for invoice generation will be debtors account debit to sale. However, if you have read Ind AS 115, you will be knowing that we will record revenue only when the performance obligation is met. So suppose the example in which we are taking, the performance obligation for the supplier is when the goods have been loaded in the transportation vehicle of the buyer and it has left the factory premises of the supplier. So the first step which we will be taking for cutoff procedures is we'll check the last 5 invoices and trace it with the gate outward register or the gate dispatch register which logs the materials which have gone out from the factory premises, and see whether all the 5 invoices the gate outward have been made before 31st March. In that way we ensure that the performance obligation has been made and the revenue have been properly recorded. In case it has gone after 31st March, we'll reverse those materials. Secondly, on 1st April, we will also take out the gate outward register and see whether there are any invoices which relate to 31st March apart from the 5 invoices which you have checked. In that way, we are doubly assured that if there are any invoices which we have missed out in our 5 samples, then also those are invoices which have gone after 31st March and which belongs to the invoice has been generated before 31st March. Those invoices reversals are also getting made. Thirdly, we will also check the gate inward register and the credit notes which are issued subsequent to 31st March and see whether there is a very high amount of subsequent reversals or sales return being made, which will give us a identification that there was a fictitious sales being booked, a high amount of sales being booked in the books to manipulate the books of accounts. Fourth, also check the gate outward register of 31st March and see on a sample basis that whatever is showing in the gate outward register, invoice has been booked and revenue has been recorded. Although this must have been done because as per GST laws also we are not allowed to take outward material without an invoice. However, as a part of control, you may check that as well. I hope now you were able to understand that how did we ensure that the revenue got properly accounted and even the trade receivable got properly accounted and accounted for. I hope you liked the video. Please do like, share, subscribe the channel, and thank you for watching.